Trump may have popularized the term fake news, but as investors watching his administration, how do we separate fake news from economic reality? That's what today's guest has been focused on. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce, and with my co-host Ren, today we're unpacking what's going on with the Trump show, how getting defensive is important, and how advisors can navigate the changing fixed income market. Ren, as always, good to be with you.
Good to be with you, Bryce. Excited for this one. Today we are speaking with Richard Quin. He is the Chief Investment Officer and Principal at Bentham Asset Management, focused on credit and fixed income markets. And Richard, along with so many of us, has been focused on the Trump show and how we navigate it as investors. And today we're going to pick his brain and understand how we can all navigate these murky waters a little bit better.
Yes, this is a fun one. He's likened it to the Truman Show.
Yes.
And has, created characters from Trump's orbit and related it back to the movie. So we had a bit of fun with this one. Before we jump into it, though, we want to say a massive thank you to Morningstar. This interview was recorded at the Morningstar Investment Conference, so thanks for having us. But equally, a huge thank you goes to our launch partners here at Basis Points for continuing to help us keep our content free. That is SIBO, Milford, and Orbis Investments. A huge thank you to our three launch partners.
And a reminder that all episodes of Basis Points are accredited for CPD points by the Financial Advice Association of Australia. To claim your points, head to the YouTube description or the podcast show notes, follow the link, complete the quiz, and we'll send you your certificate. All right, well, Bryce, with that said, let's get to our conversation with Richard Quin.
Well, Richard, welcome to Basis Points.
It's fantastic to be here, a fan.
We're very excited. So let's start with the big picture. You called it the Trump Man Show. President Trump's recent Liberation Day's tariffs sent another ripple through global markets. So how are you assessing the current environment?
Yeah, listen, it's a very unique environment, but it's a step change. And I think we need to understand that this change in tariffs is different to what we've experienced, where we've had this globalization. And while people think that 10% tariff rise is not a lot, it's a significant amount, and it will have a natural impact on trade and activity. And it has lots of nefarious effects on an economy. So maybe we can discuss that at some stage.
Well, yeah, we want to get into what the effects will be, but I think let's hold on this Trump man analogy.
Why did we do that?
You've introduced, because you didn't just label the Trump man show. You also cast all the main characters in this movie.
Give
us a sense of
it's a bit of a spoof on the Truman Show.
Yeah.
And listen, I think it's a really good show because the Truman Show was about a lifetime. Well, this is the story of an electoral term that feels like a lifetime.
Yes.
So, and definitely, it's almost a reality show because everything seems to be focusing around Trump, and he obviously is a reality TV star. Now, the Truman Show happened years and years and years before reality TV, years before even Big Brother, right? And years before Facebook and everything. So it was quite futuristic in its view of how people would get so involved in this media form. And Trump is a master at this media form. He really is. And it's just amazing that we're talking about Trumponomics now. And I did do a little bit of a comparison between Trumponomics and Reaganomics, because when I was growing up, Reagan was in place and there was a new theory coming through, and that was monetary policy coming through. Now, I think that has a lot more credibility to it, but this is definitely a step change.
So if we were to sum up Reaganomics, it would be things like, raising rates, getting on top of inflation, massive deregulation, trying to shrink the size of government and lower the tax base. You've got more,
and also free trade.
And free trade. So if we compare that to Trumponomics, what will the headlines be when history's written about Trumponomics?
Trumponomics is much more about, it's more isolationist. It's America first. It's very inward looking. And again, it's also very transactional. There's been a lot of trust that's been broken in the last 3 months. And I think that's something that it takes a long time to build up. You can destroy it really easily. I don't just think this is an easy negotiation. And so I think some of the stuff with China, like, we've delayed for 90 days. As far as China's concerned, that's a great delay because they know he's got a set time period before the next election cycle. The lower house election cycle. So it's quite an unusual time. But basically it should lead to less productivity. You're going to have higher general prices, and you're going to have less efficient industries as well. Because if you've got a tariff, it means you can compete, but you're not getting the best thing. And so, the global supply chain is quite an evolved creature. We've had years of the benefit of this, which has decreased the cost. Like, clothing used to be a lot more expensive in Australia. Just as one example. But, electronics and alike, these costs could go up. Now, how that translates through an economy and how it affects demand and how people react to it. Like, people could go around the US, which would be quite bizarre, right? Like, we're starting to negotiate with the EU now, and all the issues that we had around brand names with the EU, they're saying, oh, don't worry about that. Let's just do free trade.
Yeah.
It's an interesting sort of time, right?
So you mentioned there 3 hallmarks: lower productivity, higher costs, and one other that I can't remember. But
less competition and efficiency. So productivity is a really key thing. So lower productivity means a lower growth rate.
I was going to ask though, it does sound like we're introducing the S word into this conversation, stagflation. Do you see that as a potential outcome?
Yeah, listen, it's a potential outcome. The way most economists would look through this is if they have a one-off jump in inflation, it's sort of like a GST. And you probably weren't around when GST was instituted, but basically people look through that one-off tax. They look because it's how it affects the inflation expectation that people are worried about. Now, you can get a one-off jump, and that might just be in the US, right? So think about it. Like you've got the US with this one-off jump, and then it goes normally. That's manageable, but there's a risk of it, right? And also, the central banks made a mistake earlier on. They were a bit late to the party when inflation increased. So I think they're going to be a little bit more conservative.
Well, there's been plenty of conjecture, Richard, and in one of your most recent webinars, you listed out some of the rumours versus the reality. Can you take us through some of, I guess, the big fake news that we're hearing and what is actually taking place?
I'm surprised that Trump was re-elected in a way because there was so much volatility around that stuff before. But this is next level, right?
Yeah.
So, but the market seems to take on these theories. Like, the big thing was China was a big seller of bonds.
Yeah.
China wasn't a big seller of bonds. Like, Japan sold a bit. The big seller of bonds were hedge funds that had $1 trillion basis trade between bonds and interest rate swaps. They had to unwind that because the basis swap went against them. And obviously, when volatility goes up, when they're borrowing for those trades, people close down those trades, so they haircut the trade.
Right.
So it forced them to close out the trades. Then there were a few people that lost their jobs around that. $1 trillion, that's more than China owns.
Yeah.
It's nuts, right?
Yeah.
So that was a big thing. And also they say that bonds didn't provide protection. Bonds did provide protection. Like, we went through the numbers. Like, the bond index versus the S&P 500 gave you really good protection because general interest rates came down in that month of April. So it was really interesting. But those sorts of things are quite concerning, but it undermines things, if you know what I mean. If you have a reserve currency with an absorbent privilege like the US dollar, that's an issue. So we have some issues to deal with and get over.
One of the rumours that you listed, which I'm interested to get your thoughts on, is this long-rumoured Mar-a-Lago Accord, which is the rumoured grand monetary policy bargain that Trump is trying to institute with a number of his partners. What do you think about that?
If you restructure the term on US Treasuries without repaying the debt first, that's a default. That's a technical default. So you can't do that. You just can't do that. You just can't do that. Now, Scott Besson, I think he's a really smart guy. He's been in macro hedge funds for a long time. I think he could play the market a little bit. I think he will. I think he's got three things that he's looking at. He wants a 3% deficit from 7. He wants 3% real growth, and he wants $3 million of additional oil into the system. Like, keeping energy prices under control, that's a big deal for this government. So, and when that crosses, like it crossed below 60 last month, if it gets below 50, it's going to create some problems for some energy producers globally.
In such an uncertain environment, I think getting defensive is something that is pretty important to consider. How do you think advisors should be preparing for all of these known unknowns, whether it's recession, stagflation, US default, all of these?
Jeez, price is going big there.
Yeah, listen, you can be defensive. Like, fortunately, interest rates are higher now, so you do get some protection from interest rate risk. I'd stay higher in the quality spectrum. Like, we're a global credit and fixed interest manager, so we play in high yield and loans and emerging market debt and all sorts of things. Right now, I'd play a little bit closer to home. Government bonds actually give you a really good yield right now. Their yield has expanded relative to swap. That's part of that swap trade that everyone's talking about. So you can get a running yield from investing in government bonds, which is quite good. Obviously, with interest rates being higher, if you see a recession, interest rates will come down. The stagflation risk, yeah, it's there, but it's always there.
Yeah.
And also, I think Scott Besson's very good, but I'm not sure how much control he's got in this whole thing. And obviously, we've got many different players. Like, some of the best friends I was talking about are quite unusual. It's an unusual time.
When you think about the market and all these known unknowns, we saw a V-shaped recovery in the S&P 500. Yields rose a little bit in fixed income, but maybe not as much as people were expecting. Do you think the market is appropriately pricing some of this risk at the moment?
No, not completely, in my opinion. I actually think we've seen a short covering rally, and I don't think we're pricing on all the risks. And obviously, the market is what the market is. The market will humble you all the time. I think the market was surprised by the length of the tariffs and the change in the tariffs. I don't think we've seen the real data come through yet, but the soft data doesn't look good. And then, like, I think people were positioned for that. People have been trained to buy the dip. That may be, they're buying the dip like it's March 2020. Now, we bought the dip in March 2020 for credit in particular because it blew out, and we knew half the industries weren't going to go into recession. And this is different. This could be a broader recession. It could be broader based if you see demand roll, and the sensitivity to demand and leverage, like those trades that were blown up in March were leverage trades. So just think of look where the leverage is. And that's where things will come unstuck, usually, in a recessionary environment. Now, everyone's been changing their predictions of recessions. That's not unusual, but it's like, I've never seen so many upset economists. They're really upset. I think because people are just ignoring them in many ways. There is a history here. We have seen these things happen before. I do think the reason they're doing it is geopolitical. Like, they're worried about China. They don't have all the manufacturing base that they require to compete. So that's maybe why they want to onshore things. But hurting neighbours and friends, this is a different state, and it's very much an inward-looking US economy, which is quite unusual. But it is a large and self-sustaining economy as well, so it's weird, right?
So if advisors are then thinking about bringing like a defensive tilt to their portfolios, how do you define defensive income as opposed to, I guess, just more traditional?
Yeah, listen, I think one of the problems with just traditional fixed income is it tends to be very benchmark aware. And so as an example, when interest rates were zero, they were probably a year or a half away from benchmark. they shouldn't have had any duration because there was a negative outcome going forward. So you shouldn't have had it. Now the opposite is the case. And in actual fact, fixed interest, the way it is now with the current yields, it has an asymmetric payoff. So a 1% increase in interest rates won't hurt as much as the rally benefit you get at a 1% change down in interest rates, because you get the carry plus the capital gain. And it's also negatively correlated. Now, if something's negatively correlated, that means it's worth almost twice as much return-wise in a balanced portfolio. So I think that's an interesting thing to sort of get your head around. So you want to be active. You can be active in high-quality credit as well. And being active just means moving between those. So, like, we did not have many semi-governments. Now we've got a lot of semi-governments. We have a lot of mortgage backs, not a lot of corporates.
Well, speaking of the variety of options available in the fixed income market, we want to close with a couple of questions on how advisors can navigate the market, because it is vast and there's a lot of opportunity, a lot of places you could trip up if you don't have
100%.
expert guidance. So I guess you see it all across the market. What are, I guess, some of the trends you're seeing emerge or accelerate at the moment?
Yeah, there's obviously a trend towards private debt. The thing I worry about with private debt, and we saw it in 2008, was, if there's a need for liquidity, if you don't have access to liquidity, and some funds don't, they'll lock up. Now, a locked up fund really doesn't do much for you. There's some really bad examples of them. I'm sure there'll be some good ones and some bad ones in that space. And then I think a lot of people have sort of see credit as just a one-way bet. I've been in credit markets for a long time. It's not a one-way bet. We've been through a number of recessions, 3, maybe 4. So those things are things you need to be mindful of. And we've been in a very unusual environment post-COVID. We've had a lot of positive earnings upgrades, which means ratings upgrades. Now, the thing that really hits credit markets is earnings downgrades that drop you to, from a single A to triple B, or then double B, or from a double B to triple C. And remember, we're also at the end of a rate cycle. And that means the repricing of debt's coming through, and people need to right-size their debt. And that's one of the reasons you've seen governments get quite conservative. Like the Victorian government's a great example. They borrow too much. With current interest rates, it's too much debt. They need to pay down some debt, and they need to stop projects. That, just multiply that all around the economy. Obviously, we had a small rate cut yesterday from the RBA. That's positive. But again, that goes into the fixed interest side. It takes a long time. A lot of people that locked in interest rates haven't come off them yet. And so they're just starting to deal with that much higher borrowing cost. So it's a curious one. And then you've got two effects. That revenue effect, like in the race for the last sale, that's when deflation comes down quickly, because you compete for that last sale by decreasing your margin. That's positive for inflation, but it's negative for other things. And we've had a pull forward of demand because of these tariffs. That pull forward in demand has been pulled forward again by this additional 90 days for China. So we actually have a lot to look through here. It's a bit of a murky front screen, but I wouldn't be looking at the historical fundamentals right now, because they're going to be wrong. And they're going to be wrong because of that. It's brought forward demand, and so people are consuming now to avoid the purchase later, but they've brought forward a purchase, which means demand could roll off a bit. So there's some issues there.
If there's an area of the market that you are really excited about at the moment, what would that be?
Oh, God. You know what? I feel weird saying it, because traditionally we're more a high credit sort of player. But ironically, I think government bonds and semi-governments give you a really good yield right now. They don't have default risk. I think they're working really hard to get on top of their fiscal issues. Globally, people are now talking about the bond vigilantes.
Yeah.
When I first started in markets, that was a lovely place to be. So bond vigilantes basically mean people will actually be looking at their deficits. And the reason we have inflation targeting is because you can't trust governments on spending. So that's, if they don't get spending under control and inflation gets out of control, central banks can come in. And that's why this independence on central bank is an issue and is one of those things that's worth fighting for.
Yeah, that is interesting.
Interesting.
So as yields rise and more advisors and institutions and everyday investors come back into the bond market who maybe haven't been involved in it for the 10 years previous, I'm sure you're hearing a lot of misconceptions. I'm sure you're hearing a lot of things that you wish you could correct. So this is the platform. What are some of the misconceptions that grind
past
your gears?
returns. Like, there are so many. There are so many.
Here we go.
Like, people
Go
get rates the wrong way. So this is sort of like 94, right? 94, you had interest rates go up a lot. This is a worse bond market relative to cash than we saw in 94. And we've had years of it because interest rates were taken so low and then they were taken up. So people have had a bad experience in bonds and a good experience in riskier credit. Like we're risky credit as well. So we do both. Yeah. I would say people don't have enough bonds still to protect their portfolio. Balanced portfolios work now. It's back to traditional fixed interest management and balanced portfolio management. And then post things like the movie The Big Short, there's so many good quality asset-backed securities that you can invest in that have got really quite bulletproof now. I actually think that's something people should be mindful that they're good opportunities, not bad opportunities. And it's always like that. But people will go for the last big win. They'll follow that in, and that'll end up being a disaster. So usually the most fashionable thing ends up being a problem.
Yes. Well, Richard, to close out, we want to take it back to where we started, which was the Trump Man show. How does this all end?
Listen, I'm not sure. I think what is happening, I think there's good reasons that they're doing some of the things they're doing, and because they've got a geopolitical risk with China. I do think they believe in tariffs. And so you're going to get at least a 10% tariff rate, if not higher. I'm not sure how it ends and whether they get spending under control in the US. That, I think, is the next big thing. That they could front load a recession. They've been quite prepared to take on a recession risk until they saw the bond market get under pressure. I don't think there was really good knowledge. What I think will happen is they'll make it easier for banks to buy bonds. They're going to deregulate a lot of markets. That's going to make it easier for growth to occur. And I think they're going to try and keep energy really low, which is not a bad thing. So it could be an okay environment, but we have to get through to that okay environment. But I've been stunned by how quickly they've been doing things and how he's expanded the presidential role and those powers. That's just unbelievable. But it is very focused on him right now.
Yes, he's very focused. The world is focused on him right now.
Yes, love the analogy. Well, Richard, thank you so much for your time. We've thoroughly enjoyed this conversation. I'm sure everyone listening has got a lot out of it. So thank you very much.
Yeah, thanks a lot, guys. And I love what you're doing. I think it's great. Just keep on talking to people.
We appreciate that.
Yeah, we will. Thank you.